This lecture is over risk, the cost of capital, and capital budgeting. I'm your professor, Dr. Stephen Haggard. So far in this class, we have just been using whatever rate we were provided to work problems. In the real world, numbers are not just handed down to you from the gods of finance. We have to figure these things out for ourselves. And that's the purpose of this lecture. We're going to learn how to determine the appropriate rate of return required by a project based on the riskiness of its cash flows. So how do we determine this discount rate for our project? Well, it turns out that we have these things called financial markets where different financial instruments are traded. And based on the return patterns of those financial instruments, we can determine their riskiness and their expected return. And so what we're going to try to do is use the financial markets to find something of similar riskiness to our project and figure out what the market requires as a return for that instrument. And we'll use that on our project. Now, that's simpler than reality. Turns out that firms are financed with a mix of debt and equity. So if we're going to figure out what investors are demanding based on the riskiness of the firm, we're going to have to figure out what the cost of debt is, what the cost of equity is, and the proportions that are in the capital structure. We're going to use all that information then to determine what the appropriate discount rate is for a project with risk identical to that of the firm. First, we need to be able to figure out what is the cost of the firm's equity capital. Every firm has equity in its capital structure. There is no such thing as a 100% debt firm. And so this is important for every firm that we come across. Even though firms are not required to pay dividends, their equity still has a cost. Investors expect a return. And if you recall, there are two ways that equity can provide returns. The first is dividends, and the second is capital gains. Either way, this is a cost to the firm. So we have two ways to determine equity cost, and if you recall these from earlier in the semester, there is the CAPM, or capital asset pricing model, and the equation expression of that model is the security market line. And the second way is the dividend discount model. Here is the security market line. It's the expected return on the individual security, that's the sub I, is equal to the risk-free rate plus the beta on that individual security, once again sub I, multiplied by the market risk premium. What's the market risk premium? That's the expected return on the market minus the risk-free rate. So previously we were given all this information, which made things easier, but it doesn't work that way in the real world. We're going to have to produce an estimate of the risk-free rate, an estimate of the market risk premium, and an estimate of the equity securities beta. Let's start by figuring out how to estimate the risk-free rate. Typically, finance professionals use the annual yield on the 3-month U.S. Treasury bill. Now, is that always the case? Well, your book suggests using the 1-year U.S. Treasury bill yield, which actually does not match up with what I have seen in the finance literature. Some suggest using the 1-month U.S. Treasury bill. After all, it has less interest rate risk than the 3-month U.S. Treasury bill. But the problem is that the 1-month U.S. Treasury bill is just not very popular, so it doesn't trade that much, it doesn't have that much liquidity, and the values on this bond are not updated as often, therefore, and it makes it hard to get a recent realistic estimate of the annual yield on it. And so it really makes it less attractive for our estimating purposes. For the purposes of solving homework problems or exam problems, you should just use whichever Treasury bill yield you are given. Now we move on to estimating the market risk premium. Recall that we typically use the S&P 500 as our proxy or substitute for the market portfolio. After all, we cannot replicate the market portfolio. And so we're going to use the S&P 500 as our stand-in. We can determine the return on the S&P 500 using historical data. So that would be some sort of arithmetic mean. And we'll use that as our stand-in for the expected return on the market. But this leads to a judgment call. How many years of return data do you average in order to find that? In other words, do I use 1 year of data, 5 years of data, 10 years of data, 25 years of data? We have all the way back to January of 1926. So you'll need to make the judgment call on how many years of return data do you use. And the next question is, will the future look like the past? As of this recording, the economic future of the United States looks very different than it did just 4 years ago. And so would it be meaningful to use S&P 500 return estimates that involve the booms of the 80s and the 90s? Who's to know? We can't predict the future with certainty. So once we have that expected return for the S&P 500, we can find the market risk premium, or our estimate of it, by subtracting the risk-free rate from the return on the S&P 500, which is our stand-in for the market portfolio. Next, we need to estimate beta for the equity security. Beta for the firm can be estimated using linear regression. Recall how we use Excel to determine the beta for GE for the year 2007? The problem is that betas tend to vary over time, and so you're stuck with a choice. You can either choose between an estimate of beta over the most recent period, which might be more indicative of the current beta of the stock, but that limits the sample size that we use for our regression. If you recall from your statistics classes, statisticians love larger samples. Why? Because you can get a better estimate of something the bigger the sample you have. Unfortunately, our sample here is collected over time, and so you're trading off between the statistical accuracy of the estimate versus the temporal accuracy of the estimate, because the further you go back in time, the less likely that your estimate of beta will represent what's currently going on at the company. This is the trade-off that you have to consider when you're estimating beta. Of course, if you are working with a company that has not changed in the least over the last 10 years so far as their betas go, and you don't see anything moving into the future that would make their beta different, then you would want to use that whole 10-year time frame in estimating your beta to get a better, more precise estimate of beta. Betas for firms tend to vary over time. This is one of the reasons it's important for us to determine the proper time frame over which to calculate beta. Let's take a look at Microsoft here. From 93 to 97, the beta was 1.28, meaning that Microsoft was riskier than the market. From 98 to 2002, that beta jumps up to 1.75. Now I want you to notice that that's during the dot-com boom era, going up to about March of 2000. So during a lot of that time, Microsoft would have been gaining quite a bit compared to the S&P 500 because the S&P 500 wasn't overly crowded with tech firms the way NASDAQ was. Now moving on to 2003-2007, this is post-dot-com bust. And we're looking at a beta here of 0.86, meaning that Microsoft was less risky than the market. Microsoft by this point had become somewhat of a utility, providing Windows and Office. It was very more or less predictable. 2008 to 2012, we see Microsoft's beta edging up ever so slightly to 0.98, still slightly less risky than the market. In that time frame, if I'm correct, they started doing things like Xbox and some other projects that might have been a little riskier. So it makes sense that the beta is a little higher. However, it would be interesting to know if there's a statistically significant difference between the beta for 2008 to 2012 versus 2003 to 2007. I want to point out something else here. The way we get beta is through something called linear regression. We've already discussed how to do this on Excel. but I want you to look at some of these patterns. For instance, 2008 to 2012. That line looks like a fairly good fit. But look back to 2003 to 2007. That line is highly influenced by the black dot to the right-hand side. If that dot were in a different position, the line would have a different slope. And so linear regression sometimes fools us into thinking that we have a really solid number, such as 0.86, when in truth, if one data point were different, if it's an influential data point, then it could totally change our estimate of beta. So this is something you should watch out for when you're thinking about beta, is how well does our linear regression line fit the data? If it doesn't fit the data very well, then perhaps we should be a little more cautious thinking about our estimate of beta and how correct it is. How do we know how good of a fit the line is? R squared. The higher R square is, the better the fit. An R square of 0.95 would be an excellent fit. An R square of 0.2 for something like this would be a bad fit. So far, we've been concerned about trading off the timeliness of our beta estimate versus sample size. And this is a trade-off that you have to do if you're only using one firm's returns. However, if you find that the firm of interest is very similar to others in the same industry, then we can have our cake and eat it too. Why? Well, if it's similar, then the risk is similar, and beta should be similar for firms in the same industry. That allows us to estimate beta over a relatively short time frame, but to have a much larger sample, because now we don't just have the returns of our firm, we have the returns of the other firms in the industry. And so using other firms in the industry increases your sample size for calculating beta while maintaining that temporal currency of your estimate. Let's see if we can find the flaw in this idea. Here are the betas for several firms in the software industry. Apparently we are in the software industry and would like to know what is a good beta for us. So we're going to look at other firms in the software industry and develop an equal weighted average. In other words, just add them all together and divide by the number of observations. So let's start out here with Microsoft. Microsoft has a beta of 1.17 over the period of examination. The question now is Microsoft purely a software company? Certainly it's a big part of their business, but they are not purely a software company. After all, as I record this, I have a Microsoft mouse in my hand. Microsoft also makes the Xbox, which could hardly be considered software. Further, they make the sync systems for the Ford company, and so that would also be hardware. It would be a combination of hardware and software. So I don't think we can call Microsoft a purely software company, so we need to scratch it off the list. The next one down is Apple. Certainly Apple isn't a pure software company. In fact, I tend to think of Apple as a hardware company. I have an iPhone sitting in front of me as I record this, and it seems rather hard to me. So we can't include Apple either, so scratch it off the list. The next one is Automatic Data Processing, or ADP. If you work for a small or medium-sized organization, you may notice that your paychecks or pay stubs have the letters ADP in the corner. That's because ADP does automated payroll processing. They have a web portal where your human resources department enters your pay information in, as well as your withholdings and things like that. And ADP pulls out the appropriate amount of money and sends you a pay stub and deposits the correct amount of money into your account as well as other accounts from your company's checking account. Now, that doesn't sound very much like software to me. Certainly there's a little software involved in creating the web portal and in printing the stubs, but primarily I would classify this as a business services firm, so let's scratch it off the list too. Next we have Oracle. Oracle is a big database company, and if you had asked me 5-10 years ago if Oracle was a software company, I would have told you absolutely. But then Oracle purchased Sun Microsystems. As a former engineer, I can tell you that Sun Microsystems makes terminals used for computer-aided design. It doesn't seem very soft to me. That's hardware. So Oracle is not a pure software company either, so we need to scratch it off the list. I didn't know what computer sciences did, so I looked them up. They appear to be some sort of information technology consultancy that will help you solve problems using information technology. In other words, they're a consulting firm, not a software company, so we need to scratch them off the list as well. CA is Computer Associates, and Computer Associates buys up licenses for old, obsolete software and then provides support for them. In other words, they are a service organization, not a software firm, so we need to scratch them off the list. Fiserv provides IT solutions to the banking industry, so the software portion of that would certainly count. However, they also run systems that transfer money from one point to another, and so that would really be some more financial services angle as opposed to software, so we need to scratch them off the list as well. Accenture is another computer consultancy. My cousin used to work for Accenture, and what he did was go into businesses and implement other people's software into the business so that the business could use it. In other words, he was using software from SAP and Oracle and other companies, not software that Accenture had written. So we need to scratch Accenture off the list as well. Symantec is the provider of Norton Antivirus, and that's probably the only pure software company up here. However, it's a very strange kind of software, so unless you were also in the antivirus business, I would be very reluctant to consider Symantec as my benchmark. And then finally, Paychex Inc. Paychex Inc. does exactly the same thing as automatic data processing, so we need to scratch them off the list as well. So how many firms are we left with from this list that we could average together? Precisely none. Now let's talk about a couple of things that impact beta. The first is business cyclicality. What does cyclicality mean? Well, if your business sells more stuff during good times and less stuff during bad times, then your business is cyclical. On the other hand, if you sell more stuff during bad times and less stuff during good times, you're considered to be countercyclical. Now remember that beta represents sensitivity to systematic or market risks. So if your business does well when times are good, then you're going to have more of a positive beta. On the other hand, if your business does poorly when times are good and well when times are bad, it's possible that your firm would actually have a negative beta. Now let's talk about something else that impacts beta. It's called operating leverage, and that is simply the sensitivity of earnings before interest and taxes to changes in sales. In fact, we can define operating leverage as the percent change in earnings before interest and taxes divided by the percent change in sales. Remember that delta, or the triangle, represents change in equations. Now let's talk about what an operating leverage of 3 would mean. It would mean that if sales went up 10%, that your operating profit, or EBIT, would be up 30%. That sounds pretty nice. Now let's look at the other side of that though. What happens if sales are down 10%? That's right, EBIT would be down 30%. Are you so happy now that you've got a high operating leverage? Probably not. Now operating leverage magnifies cyclicality when we look at the impact on beta. Why is that? Well, if your business is cyclical, then your changes in sales are driven by changes in the economy and are therefore systematic. In other words, they're going to impact beta. You can't diversify them away. And so if a business isn't cyclical at all, the operating leverage has no impact on beta. But any cyclicality that the business demonstrates is magnified by operating leverage and shows up in beta. What are the roots of operating leverage? Well, it turns out it's the mixture of fixed costs versus variable costs. Think about an operation where there are no fixed costs whatsoever. Every cost is variable. I once saw a recording of a guy in Switzerland making luxury watch bands at his kitchen table. And almost all of his costs were variable costs because he didn't have any fancy machines, he didn't have a factory or anything like that. He only had a few hand tools, and the rest of his costs, his labor, his glue, his leather, his buckles, were all variable costs. He had an operating leverage of roughly 1. But what if he had invested in a fancy machine? Then he would have fixed costs every year associated with that machine, regardless of whether he made watch bands or not. Now, as he made more watch bands, certainly the variable cost per band would be smaller than the old method, or he wouldn't have invested in it. And at some point, he's going to break even, and beyond that, his profits are just going to climb. And so we see that operations that have a lot invested in fixed assets have high operating leverages. Think about GM. They had, but prior to the bankruptcy, had lots of fixed costs and low variable costs, relatively. And so when times were good, their profits would grow. However, when sales dropped as a result of the financial crisis, it was too much for them to handle because their profit dropped even more because of their high operating leverage. Another thing that can impact a firm's equity beta is financial leverage. If you have an all-equity firm, then the beta of the equity and the beta of the underlying assets are the same. What do we mean by the beta of the underlying assets? Well, we're talking about the sensitivity of the underlying assets to systematic risk, just like we would talk about with a stock. Okay, so what can make this beta larger? If the firm has debt in its capital structure, then the beta of the equity will be higher than the beta of the underlying assets. Think about this. What's the probability of a firm with no debt in its capital structure going bankrupt? It's 0. Now, as you add debt into the capital structure, the firm's probability of bankruptcy goes up and up. The firm becomes riskier and riskier. And so the equity claim on the firm would be riskier and riskier. Therefore, the firm's equity beta is higher. Now, there's some mathematics to this that we could go through, but that little idea is just to help you to be able to recall the relationship between leverage and the equity beta. So once again, the idea is the greater the leverage, the higher the equity beta for the same underlying assets. Of course, anything worth expressing in finance is worth expressing in an equation. And so that's exactly what we're going to do. We're going to show the relationship between financial leverage and beta. Let's start with the concept that we can observe the beta of the equity and the beta of the debt through the security markets. We've already showed how to calculate beta for a stock using linear regression. We can't observe the beta of the assets underlying the equity and the debt directly. So we have to get at them through an equation using what we can observe. And it's basically just a weighted average of the equity beta and the debt beta. So in this case, E is equity, D is debt, and D plus E is debt plus equity, or total assets. And so the weight that you see there on the equity beta is merely the proportion of the firm that is financed with equity. Conversely, the weight we see on the debt beta is the proportion of the firm that is financed using debt. And so we just have a weighted average of these betas here. That allows us to calculate the beta of the underlying asset. A common assumption in finance, unless you are told otherwise, is that the beta of debt is equal to 0. Why would that be? Well, remember that beta is a measure of systematic risk, and so actually sensitivity to systematic risk. Debt is a fixed set of payments that is not sensitive to economic conditions unless those economic conditions cause the borrower to default. And so normal fluctuations within the economy are not expected to change the payout pattern of debt. Therefore, we could assume beta of debt is equal to 0, unless you're told otherwise. Now, the cool part is that makes an entire term drop out of the equation that we just looked at, because when you multiply anything by 0, it turns into 0 as well. So the whole beta debt term just falls straight out. We can take the remainder of that equation and we're going to rearrange it to determine the equity beta based on leverage and the beta of the underlying assets. Now we're going to do a little algebra to get the beta of equity by itself. And that equation there at the top is simply the equation from the previous slide with the 0 term dropped. So how do we get beta of equity by itself? Well, we divide by E over E plus D, which is the same as multiplying by E plus D over E. And so that's what we do to both sides. And that makes the E over E plus D on the beta of equity cancel out. And so now we've got beta of equity is equal to E plus D, or total assets, over equity multiplied by the beta of the assets. Now we can simplify that further because that E on the top will cancel with the E on the bottom, leaving us with 1 plus the debt to equity ratio. 1 plus the debt to equity ratio, we know from chapter 3, is also called the equity multiplier. And so our beta of the equity is merely the beta of the assets times the equity multiplier. So now we can see that as leverage gets greater, the equity beta increases for the same underlying assets. And so every little extra bit of debt that you take on, given the same underlying assets, increases the beta of the equity. And that's especially true if you take on debt and repurchase shares, because that makes D larger and E smaller at the same time. Okay, so we've talked about the security market line, or capital asset pricing model. That's our first way to determine the required return on stock, or the cost of equity. The other way is the dividend discount model. And that's just a reorganization of that formula that we used earlier that said that P0 was equal to D1 over R minus G. And so we're going to rearrange that. R is equal to D1 over P0 plus G. Now, keep in mind, this only works for firms with a constant rate of dividend growth. And it only works for firms that pay a dividend, because otherwise there's no D1 to put in there. And so this model would work for actually a very small subset of all firms. Now, along the way here, you're going to have to estimate G. And we can do that one of two ways. We can either do it by the historical growth rate in dividends, which we could easily figure out just looking at historical dividend data, or by taking the retention ratio and multiplying it by return on equity. Recall that we did this when we were examining the NPV-Go model. Now that we found the cost of equity, we need to be able to also find the cost of debt. And to find the cost of debt for a firm, we simply examine the required yield to maturity on the firm's publicly traded bonds. In other words, GE sells bonds to the public, and they're traded, and those values get reported. And since we know how to calculate a yield based on a bond price, its coupon rates, and its maturity and all that, we can figure out what yield is required for those bonds. And we can use that yield as the required cost for debt. Now, if the firm has no publicly traded bonds, you can always call your friendly neighborhood investment banker, and they could give an approximation of what yield the market would require for the firm's debt given the firm's current level of riskiness. Now, this may sound far-fetched, but I actually have a friend who worked at a company called Calpine, and it was his job to help that company raise money for projects. And he would call up his investment banker at Goldman Sachs and ask this very question. If we were to sell bonds today, what kind of yield would we have to pay? And what would be the best kind of securities to issue? And investment bankers actually must be fairly good at this in order to make sure that the investment bank makes money when they agree to underwrite or issue a firm's debt. Okay, so one thing you need to keep in mind though is that we use yield to maturity, even though an effective annual rate might make more sense. Remember that yield to maturity is an APR. It doesn't take into account compounding that happens within the year. Nonetheless, we continue to, as a matter of convention, use yield to maturity. The other thing that you have to keep in mind is that interest is tax deductible. So we're going to have to make an adjustment for that because, after all, we are only interested in the after-tax cost of debt. Now we're going to put it all together to come up with a single number that represents the cost of capital for the firm. We call this the weighted average cost of capital, or WACC. To determine the firm's cost of capital, we need to take a weighted average of the cost of equity and the cost of debt. Plus, we have to account for the tax deductibility of interest. And so the formula you see here, our weighted average cost of capital, is simply a weighted average of the required return on the debt and the required return on the equity. Very similar to what we saw when we were looking at beta of the asset is equal to a weighted average of the beta of the equity and the beta of the debt, with one difference. This time we're going to multiply by 1 minus t sub c over in that debt term. And the reason we do that is because the interest on debt is tax deductible. Notice that t sub c is the corporate tax rate. Think about this. If I have to pay $1 in interest, that's $1 less taxable income that I must report. Let's say my tax rate is 25%. That means that for every $1 less of income that I report, I pay 25 cents less in taxes. And so the interest there did not actually cost me $1. It cost me $1 minus 25 cents in taxes. It actually only cost me 75 cents to pay $1 worth of interest. And so that's why it's important for us to make that adjustment to the return of debt. Let's do a WACC example. Your firm is financed with 2/3 debt, 1/3 equity. Remember, those weights always must add to 1, and in this case they do. 2/3 plus 1/3 is 1. The return on equity is 15%, the return on debt is 12%, and the corporate tax rate is 25%. All we have to do is enter this information into our equation. So the terms are 1/3 times 15% for the equity side, and then for the debt side we have 2/3 times 12% times 1 minus 0.25. And when we do the math out, we can see that the first term comes out to be 5%, the second term comes out to be 6%. When we add them together, the weighted average cost of capital is 11%. Now here's something that students often get confused about. They say, wow, if debt is so much cheaper, perhaps we should just use as much debt as possible. Here's the problem with that line of thought. Our WACC actually represents a return required based on the riskiness of the underlying assets. And so if we do additional amounts of funding over on the debt side of things, it won't lower our WACC. It will in fact raise the required return on our equity. Remember that our equity beta goes up with leverage? The required return on equity will go up as we add leverage. We're not going to save anything other than the modest tax savings. And so the whole decision process between equity and debt boils down to balancing that tax savings versus the increased probability of financial distress. We have to balance those out. So far, we have been talking about projects that are just as risky as the firm. For instance, Nissan building another Nissan Sentra plant. The Nissan Sentra is a proven technology. It's been being produced by Nissan for many years. It is just as risky as any of the other internal combustion engine products that Nissan makes. However, let's think about the Nissan Leaf. The Nissan Leaf is an electric car. That's a new technology. And the Nissan Leaf uses laptop batteries, basically, to store the electricity. Now, what do we know about laptop batteries? They have a tendency to explode or catch fire. And the batteries in electric cars are located, for purposes of the center of gravity, they are located beneath the passenger compartment. Do you see the potential for increased risk with the Nissan Leaf versus the trusty Nissan Sentra? As a result, the Nissan Leaf project should require a greater rate of return than a new plant for the Nissan Sentra. How do we determine the appropriate discount rate for such projects? Well, the first thing we could do is to find a pure play firm in the field of the new project and use that firm's RWACC as our discount rate for the project. In this case of the Nissan Leaf, we're very fortunate. Tesla is a pure play electric car company using very similar technologies as the Nissan Leaf. And so we can just go out and determine Tesla's RWACC and use that as our discount rate. A lot of times it's hard to do that, and companies may in fact have a simple setup where they have their weighted average cost of capital, and projects that are riskier than average require an additional 2 percentage points on top of that, and safer projects use a rate that is 2 points down from RWACC. It's not very scientific, but it does make some adjustment for the riskiness of projects. Many corporations have a single corporate discount rate that they use for all projects. When I worked for Halliburton, our corporate rate of return was 11.9%, regardless of the risk of the project. My group made subsurface safety valves, which are basically just metal tubes with springs and O-rings, so basically 19th century technology. Across town in Fort Worth, Texas, there was a group that made logging tools. Now, don't think of it like logging as cutting down trees. Think of it as sending a sophisticated electronic device down a well bore to examine the rock formations to determine where the oil and gas was and how much of it was there. And so these sophisticated electronic devices probably had about as much brain power as your iPhone. And keep in mind, this is the early 90s. They would bombard the formations, and the computer would crunch the data and send the information back up the wire. Now, what sounds like a riskier undertaking? Making metal tubes with springs and seals, or putting together these highly sophisticated electronic instruments? It turns out it's actually quite riskier to put together the electronic instruments. Think of what happens when you drop your cell phone in a toilet. It doesn't last for very long. Now imagine trying to get your cell phone to survive in an environment with hundreds of degrees of temperature and hundreds of pounds per square inch of pressure and noxious sour gas. It's very difficult to do. The problem, though, was every time these folks undertook a project, they would be able to get their project accepted because it would return more than the corporate rate of return of 11.9%, even though it should have been rejected. On the other hand, I would put forward projects that return slightly less than the corporate required rate of return, and those projects would get rejected even though they were profitable based on the risk of my operation. And that's what this picture is all about. Notice that we have basically the security market line, and the required return for projects is also determined by the SML based on their beta. The beta of my projects was actually fairly low, and the beta of their projects was fairly high. And so my projects didn't require as much return as theirs. But under the corporate system of a single required rate of return, their unprofitable projects would get accepted, that's the one on the right hand side, while my profitable projects would get rejected. That's the danger of a single corporate discount rate. You end up accepting a lot of unprofitable high-risk projects while rejecting profitable low-risk projects. And over time, what that means is the assets of your firm become riskier and less profitable. One area that commonly confuses students is flotation costs. Flotation costs are simply the money you have to spend to raise capital. Whenever you sell securities, be it stock or bonds, your investment banker takes a cut. In fact, what your investment banker does is buy these instruments from you at a discount and then sells them to investors at full market value. The difference is how the investment banker gets paid, but it's actually a cost to you because if you could have sold these directly to the investors, you would have gotten that money instead of the investment banker. So it's a cost. Flotation costs are higher for raising equity because it's riskier for the investment bank. Why is that? It's something called inventory risk. When the investment bank buys the equity off of you, the chances for the price of that equity to change dramatically while it's in their possession or inventory is much greater for equity than it is for debt. And so flotation costs, therefore, are higher for equity than for debt. Flotation costs are considered up front as an expense at the beginning of the project. They do not impact the weighted average cost of capital. It's sad, but many students will take the weighted average flotation cost and add it to the weighted average cost of capital and make that their discount rate for the project. That's absolutely wrong, and you should never do it. So we're going to figure out a weighted average flotation cost for the firm. Now, when you figure flotation costs for a particular project, you should always assume that you raise funds in the same proportions as your current debt-to-equity ratio. Why should we do this? Well, probably your firm is attempting to maintain a target debt-to-equity ratio. Sometimes students think, since debt is cheaper to raise, that we should just fund the project with debt instead of equity. That way our flotation costs will be lower. However, eventually, what that's going to lead to is the firm moving away from its target debt-to-equity ratio and having to go out and issue a bunch of equity in order to get that ratio back to where they want it. And so they're eventually going to have to spend those flotation costs anyway. And so what we do is we just go ahead and calculate our weighted average flotation costs based on the firm's current capital structure. Of course, we couldn't go very far without throwing an equation in. After all, this is finance. And what we have here is F sub O, that is the overall flotation cost. It's going to be a percentage. And we calculate that using the flotation costs for stock, F sub S, and the flotation costs for bonds, F sub B. And we use the same weights we've been using throughout this lesson to determine our overall weighted average flotation costs. Now, note that there's no 1 minus T sub C here. It turns out that the tax deductibility of flotation costs are the same whether you are raising debt or equity. The only difference we see in taxation between those two is in their payout of interest and dividends, not in their flotation costs. Here's a final note before we move on to calculating our flotation costs. If you are using internal equity, that is, retained earnings, your flotation cost for that equity is 0. And in that equation that we just looked at, you would just set F sub S to 0, and that entire term would drop out, which makes funding your project cheaper and determining the weighted average flotation cost easier. So here we work a weighted average flotation cost example, and you get to see how we include this cost in the project. The first piece of information you need to know is that your company is financed with half debt. If it's financed half with debt, what does the other half have to be? Equity. They always have to add to 1. And so the flotation cost for debt here is 5%, and for equity is 15%. So what's your weighted average flotation cost? Well, we just go ahead and put these numbers into our equation as shown and find that our overall flotation cost is 10%. That's the first step. The second step is to figure out in actual dollars how much we're going to spend on flotation costs. The problem states that we need $100 million. That's the amount of cash that you need to undertake the project. How much would you have to raise in order to get $100 million after flotation costs? Well, we come up with this little formula. The amount needed is equal to the amount to be raised multiplied by 1 minus f sub 0. After all, you're going to have to pay f sub 0 to the investment banking firm, so it's not money you'll be able to keep. And what we do is rearrange this thing and say the amount to be raised is equal to the amount needed divided by 1 minus f sub 0. And then we fill in the blanks. The amount needed is 100 million. F sub 0 is 0.10, and so when we do the calculation, 100 divided by 0.9 is $111.11 million. And so how do we fit this into the project? What we're going to do is use negative 111.11 million as our first cash flow, not minus 100 million as we would if there were no such things as flotation costs. Notice at no time did we add the weighted average flotation cost to the weighted average cost of capital.